Okay, let's answer some questions from the last market outlook. It's Thursday, 5:04 p.m. in Costa Rica. Had a busy 2 days with the pool repair people here, fixing leaks. I think we got it now. I think we got it. Fingers crossed. Okay, I haven't had a chance to read any of these, so these will be new to me. Let's see. First one I think is just a comment. Yeah, first one's just a comment. Okay. Second one's just a comment. I was thinking about starting a YouTube channel to apply my knowledge and hope to build around a community just like you. What was your suggestion, recommendation with your experience? If you're going to do that, do it honestly and make sure that you are delivering something of value. All too often you have some channels that are out there that don't really add a lot of value, but always hit you up to buy their stuff, but they're not adding a lot of value. Or they'll start to explain something and then they'll say, to learn more, head on over here, head on over there, which means it's a lot of work on my part to get what I thought you were providing me for free, for some information. If you're going to start a channel, be authentic, find your own voice, and relax on the hard sale. If you're good, if you're inspirational, people will seek you out. They will buy from you. Try not to sell to them because it just turns people off. Inform them. If you've got a product to sell, inform them, but don't tie your videos up with their subscription by only giving them a little bit and then telling them to go to the site and get more. I think I've done a pretty good job of avoiding that. I don't know, maybe I haven't. Maybe some people say, the guy never tells us anything. I actually think Interent is a much better buy than Capri. I want to pick a REIT that is concentrated in cities where most immigrants move to, GTA, Vancouver, Montreal, and avoid places that have a tight rent control. Vancouver is out, thanks BC NDP. Well, you've got Toronto NDP as well, right? The mayor of Toronto is really left-wing, and my understanding is that property owners, at least renters or landlords, do not like her. So I think there's something in there that they don't like. I'm not sure what. That's why I think Interent might be better than Capri. Both have similar NOI margins and valuations. Capri is too diversified geographically. What do you think? Yeah, I think Interent is really big, like Hamilton right through Toronto, Pickering, places like that. It's kind of in that Golden Horseshoe area. And that is primarily when immigrants come to the country. We don't have Canada. We have like 4 cities that get, I think, 80% of the population growth. So, yeah, I think you'd be okay there. I haven't seen Interent perform really good on price yet. Killam performs really good on price, and so does Capri when it does perform, but Interent kind of just lags. Maybe you might want to look at Minto as well. Let's see. For your beta approach, you often referred to earnings and earnings growth. For fiscal year 24, we see the earnings growth is mainly backloaded into Q3, Q4, or at least the earnings expectation. With inflation slowing down and continued labor shortages, I have a hard time seeing earnings growth of 17 to 18% in Q3, Q4 compared to 2023. You always had some kind of opinion on beta evolution, but I feel this breakdown of the sources of growth in your analysis has gone missing since you were wrong on beta in 2023. How do you look at this? In this video, I'm quite surprised you didn't form your opinion on where you expect beta will go for the SPY for 24. Well, when you're wrong for so long, you have to back away and say, okay, I must be missing something. And my thinking is the markets were behaving far more behaviorally than rationally. And when you have a concentration of a small group of stocks that pretty much control everything, forecasting in the S&P is tantamount to forecasting 7 stocks. So it's not really a macro play anymore. It's more of a micro portfolio, 7 out of the 505, and they perform quite behaviorally. So it's, I don't know, it's anybody's bet at this point. I don't know. I mean, I really don't know. That's the point of not providing anything, is when you have no opinion, then you're neutral. And I am neutral on beta from a top-down perspective. If I had to price it fundamentally, I agree. I think growth of 17-18% is going to be hard to come by year over year for the quarter across 505 stocks. I think it's going to be hard to come by. I think fundamentally we should be 2 to 3 multiples lower than where we are at this point in the cycle, being given that earnings really haven't given back and we're about to lower rates. Had earnings given back a lot and we were about to lower rates, then I would say you could justify a higher multiple going forward, because there's going to be significant improvements in earnings. I just don't see significant breakdown, but for that I think you need a catalyst, some event, but I don't see significant upside. This is not a 20.5 multiple market on a forward basis. This might be an 18 forward multiple, 2.5 multiples down. So take $233 and multiply by 2.5. What do you get to? Some 600 points lower, 4,100, 41, I think today. And if we think about the sources of growth, if I price it fundamentally at 4,100, you have your expected return. Breaking it down into the components, you have a dividend yield of 1.8%, and there's some aggressive stock buyback. So let's say 1%, that the S&P 500 will buy back 1% of the outstanding shares. I think earnings growth came in at 3.7% on last GDP. And if we had 4.1, I would say we have no multiple compression, but I don't see multiple expansion, so I'd give it 0. If we stay at 4,700, I think you have 2.5 out of 20.5. Where's my calculator? I'll do it quickly. 2.5. I get it. I'll get it. That's 12. So that would be negative 12 point. What do we got? 2%. So 2.8, 5.8, 6.5 minus 12.2. That's 5.7% lower than 4,700. Right. So if I take 4,700 and multiply it by 0.943, I get to a year-end target of 4,432. Or you can take 4,100 and say that if you have 0 here, say you get a 6.5% growth. 4,100 times 1.065, I get to 4366. So my range would be 4366 to 4432. Call it 4400 for year end. If the market wanted to start to behave fundamentally, I think that's probably a good fundamental place to be, given that this is the dividend yield, basically a little bit lower given the price that we have, probably 1.7. I'm giving a 1% buyback on shares. Maybe it's higher, maybe it's lower. And let's say that we continue on with third quarter earnings growth, corporate profit growth rate 3.7%. I get to 4,400. Does the market seem to you like it wants to go there? It doesn't seem like it to me, unless there's disappointment in earnings and the promise of AI is still 4 quarters away. You still have the AI in the background and the growing chorus of we're looking past 2024. We're looking past, like what you had last year. We're looking past 2023. We're looking past. You can't discount the behavior of the market. But on a fundamental basis, I would go ahead and say year-end target 4,400. And that's assuming a respectable multiple of 18.5, or well, let's say 18, 4,400 and a forward multiple of 18. Let's see what we get. Let's see. Next one is just a comment. Where is my mouse gone to? There it is. When investing in something like TLT, is there a benchmark to compare it with? Well, TLT is a passive ETF. So if you were investing in bonds, TLT might be your benchmark. But if you look at TLT's what the PDF that describe the name of it, just my brain does this every now and then, says, oh, you want this word? This is the word you're looking for? I'll give it to you in about 10 minutes when you don't need it. It's prospectus. There, it gave it to me. It said, oh, you got me. You know what I mean? I caught on to it. Now, if you look at the prospectus, you will find whether it has a benchmark or not, but it's really just holding treasuries. How is alpha calculated for fixed income securities? Alpha from fixed income securities comes with positioning versus a benchmark. So a benchmark with a duration of, let's say, 12, and you design a portfolio with a benchmark of 12. Let's say you're not allowed to deviate from duration. Then it's a matter of distribution along the curve. Where do you want to place your bonds to still maintain a duration of 10 such that you do better than the benchmark? So alpha is simply just doing better than the benchmark by overweighting or underweighting particular sectors or particular tenors. I shouldn't say sectors, particular tenors on the yield curve. Maybe being underweight the 2 or overweight the 2 and underweight the 10, something like that. Must admit, I totally agree with your ideas. Okay, let's just stop there. Everything is a you can ignore everything before the but. There's a button here somewhere. I'm still long TLT. I've started building long position in copper and EMX China in the last month. I don't like general EM ETF because China is usually too heavy. Take my time to build my position in EM, as I think the beginning of the year will be volatile, and well, for S&P it has been as well. Huh? Probably have better opportunities to grow those positions. I've also built a long position in utilities during 2023. Return for 2023 were a bit on the lower side because utilities dragged the return down, but I'm getting good dividend. Yes, you are. My question is, I think I remember you saying you don't like to invest outside the U.S. stock market because there aren't enough opportunities. Most companies have an international exposure through their market. Do you think about going long EM, even if that's how you see it? If to do that, I would, sorry about my chair, it's still squeaky. I would do it with ETFs. I know nothing really about the Indian market. I just know that it is probably the next China, and I think that it has seen momentum and probably will continue for some time. Same with Mexico. You know that these are holding periods of multiple years. I'd do that through ETFs because I don't know how to pick stocks in either one of those markets. I wouldn't even be able to name you a company in the Mexican market at all. Pemex, I guess. I don't know if it's publicly traded. Several questions. 2 elements to every trade idea: the theme and how much the theme is priced in. Could you give some thoughts on how some of the duration gains are not priced in, especially given Fed funds futures are pricing in 6 rate cuts? Well, that means they're pricing in too much, let's say, based on where the Fed is. Would be interested in some more detail on how the market is failing to price in all of these ideas. No, they're pricing it in. They're overpricing it. As we've seen for the beginning of the year, the market is rethinking certain things. It's rethinking some of the multiple it gave to the S&P. It is rethinking TLT a little bit. I mean, it broke 100 last week. It tried to push above 100 first week of this year. I think it's just been 3 red days. No, we've had 3 trading days, 2 red days and a green day, a small green day and 2 red days. Today being a big red day, and I think a retrace, and I've said this before, I think a retrace to 95 is probably a healthy thing. You can't just go in one direction forever. You got to have some period of consolidation to see if the gains hold. So if we hold above 95, it adds credibility to the value of where we are and a base to go higher. When you start thinking about how do you know something is priced in, you really don't. You know, it's not a science like physics, where you can calculate something with a fair amount of precision to, to 3 decimal places. It's a craft, right? And a craft is, well, there's some textbook learning and then there's some real world learning. So it's part art, part science, and some things is just a gut feel with experience, that you see something, move up significantly over a period of 6 weeks. You start to feel uneasy about further gains. Not that you've changed your mind about your fundamental story. It's just, hey, I think we've gone a little bit too far here. I think in the next couple of, maybe for the next month to the next meeting, we should just relax a bit. Tomorrow is jobs day. That's going to be a big risk event for duration. So we'll see what that provides, and if it gives a lift to, if you have low numbers, it certainly is going to give a lift to bonds. With the home builders play, what happens if government regulations just don't budge and houses just don't get built? Well, then that means you still have low supply, and low supply means higher prices. It's margin, right? Blue cities in the U.S. especially are hostile to new housing, often given in to NIMBY protests and litigation actions by concerned environmental groups. Yeah, and concerned environmental group. Not, everybody should have a house, but don't build any affordable housing near me. Build it over there. Those people over there, right? He said that houses simply must be built. Well, they must. And cities like Sydney demonstrate that's not necessarily the case. Okay, well, I'm not familiar with Sydney, so I'm not sure what evidence you're providing is that is not the case. So what is the mechanism that dictates housing must be built? Well, where are people going to live? Unless you get comfortable with tent cities, if you don't build housing, where are you going to put everybody? Like, where would you put them, right? If you're going to put them in apartment buildings, well, they have to be built. Rather than prices just pushing higher and people living with parents, friends in higher numbers than now. Well, that probably is a reality. Is that the north or the western style of living, one household per family, or one family per household, is probably something that we may have to say goodbye to. That you have more of an extended family or multi-generational families in a household, which is a more Eastern way of living. They've done that for centuries. It's sort of unheard of to tell your parents that they can't live with you and that they need to go to a home and live somewhere else. That's just unheard of, really. Is they just live with you, multi-generational. And that could be the reality, I guess you'd say, for the Western style, the Western lifestyle. If housing isn't fixed, yeah, you could do that. If you're ready for it, right? Is North America, for example, ready to make that kind of change? How do you decide when to sell puts at a certain strike versus a certain delta? Well, sometimes you can if you were following I guess you'd say a more algorithmic strategy of constantly selling puts on an underlying, you'd probably target a delta, right? 20 delta all the time. But if you look at a price chart of Oxy, it's well supported in the mid-50s. It has revisited that area a number of times and found support, and up it went. And every time it revisits the mid-50s, it doesn't take long before we have some filings with the SEC that Warren Buffett has bought some more shares. So that's pretty much where I set the strike. And yeah, sometimes you're getting 0.4 deltas out of that. You're getting nice big premium. Never been put to me. I assume if GM pushed to say 50, I assume you wouldn't be selling 45 puts just because they're 30 delta. Depends. They did a $30 billion accelerated buyback. Are they going to do another? Sorry, a $10 billion. Are they going to do another one next year? And another one. If they did that 4 years in a row, there'd be no outstanding shares. So if they did it for another year, I mean, you're talking about this, even if they have no increase in market cap, the same market cap, each share would be double the price. Before they did the buyback, it was 28, you'd be at 56 bucks. So if they keep buying back stock to have some kind of stock price performance, because the market's not giving them any respect, either they really start performing or they'll just continue to buy back stock. If they're not going to be rewarded by the market, and they really do see value and they are generating those kind of big cash flows, if you're trading at 4 times cash flow, buy your company back, take it off the market, right? Whoever's left holding shares will be, well, think of it, there's one share left, it'll be a $30 billion share or $40 billion share. So yeah, as you reduce the share count, the stock price climbs not linearly but disproportionately, right? So it's if they keep doing that, yeah, I would sell it. I'd keep selling the puts, yeah. When doing theta allocation, do you worry about market fluctuations selling the options? No, because you are following your rules. You're simply following your rules, and if you are selling calls and selling puts, you tend to, you'll tend to make money on one, and hopefully you're selling puts on stocks that hold up well, and you're selling calls on stocks that just lack any upside. Not really. There'll always be volatility and bouts of volatility. So it's not as if just because you're doing something you're going to make money every single month, or every single week you're going to make money, or every single trade pays off. Sometimes you'll have a couple of weeks where nothing's working out. After a couple of days of nothing working out, that's where you just step to the sidelines and say, okay, you know what? That strategy isn't working. Let me try my other strategies. So you have diversification with respect to the underlyings that you're choosing. You should also have diversification of strategies. You can't just be all theta, right? You have a sleeve in your portfolio that, okay, I'm going to dedicate this much for theta. I'm going to dedicate this much for, some other strategy, whatever it happens to be. Maybe it's bull spreads or put spreads or however you want to do it, but you need diversification across strategy. So think about an institutional investor investing in hedge funds. They look for diversification across hedge funds, diversification across strategy. So think of each of the sleeves in your portfolio as a separate hedge fund that's doing one thing, and you're a hedge fund manager of all of them. You need diversification of strategy because not every market lends itself well to every strategy all the time. So and trying to time markets, shift to this, shift to that, that's hard to do. That if you have a portfolio of tools that you use, yeah, that's better than sticking with just one, because there are times where it's just not going to work for you, and not every underlying is a target every single month. So Oxy might be a target 5 times a year, and 7 months out of the year you go, no, I don't feel like selling puts on them, only in certain areas. So you end up with a list of 20 or 30 that you like, and every month maybe 5 or 6 of them are ready for you. Patience, right? It's all about patience and waiting for the pitches to line up in your favor. Let's see. Regarding debt spending, especially in the U.S., how do you envision the following macro dynamics playing out? Long-term U.S. debt fetches higher yields towards 4.5 or even higher. Compare these yields to the returns of the S&P index over 10 years, might only be marginally higher than 7%. On a risk-adjusted basis, therefore, would money flee from public markets to buying debt? Usually money leaves public markets when you have extended periods of volatility of I'm up, I'm down, I'm up, I'm down, I'm up, I'm down, I'm up, I'm down. Oh, forget this, right? Forget this. I'm not going anywhere. Every time I make it, I give it back. Bonds are yielding 4.5. Good enough. Let me hide out there for a while. So, yeah, I don't know that money would flee public markets. Money doesn't really ever flee unless you have some kind of big exogenous shock. given the world we're in, given what happened in Iran, who knows what's going to happen over there, right? Who knows where this goes? I don't know that I can answer this question. I mean, I don't know that it's enough to have an answer on it. No. And saying over the next 10 years, that's I don't know that anyone is really thinking that that's the case, that yields would push higher. Yeah, I'm going to pass on that one. I am using IB. Is there a function where I could view the ETFs available to me and their corresponding fact sheets to gain exposure? Well, if there's a ticker, yeah, and then you can. IB does have a feature that you can. I don't know the name of it now, but it's just a fundamental viewer under. I'm not sure which menu it's under, but look for fundamental viewer. Type in the ticker name, and it should give you quite a bit of information. A better place to go is Morningstar. Go to Morningstar if you're looking for any information on ETFs. Can you do a detailed analysis video of the Indian economy? Nope. I know nothing about it. It would take me months to truly understand it, maybe even a year. I know nothing about it, nor do I have any desire to learn a whole new economy. No, I'll pass on that one. I've been following along with your ideas. Great. However, this week I had some issues with my spreads, GM and agency, nothing major. My stops got triggered because of the market decline for both. However, I had a put ratio back spread on the SPY that's starting to pay off to compensate. Just wondering if you had any advice regarding setting up stops or how to manage the general decline in the market affecting bull spreads. Well, the spread becomes difficult, right? Because you have two options, but a spread is defined risk. Let it play out. I would say is just let it play out. It's defined risk. Your loss is limited, and volatility will happen. So you have to sort of think about, at the end of the term, where do I see the price? But on any given day, there's going to be volatility. I don't know that those types of questions. How do you think about that, or how do you set up? There's no, other than you setting your own rules. There's no objective criteria for that. There's no rule written down that says this is how you do it. Sorry, if there was rules, you would not be needed. If the market were deterministic, none of us would be here. We wouldn't even be paying attention to this, and it wouldn't even be a discussion because it would be run by physicists, and it would be solved, and it would be run by an algorithm, by a large company that owned the data and owned the feed and had proprietary access to it. We wouldn't even be involved anymore. But it's not. It's just one big game, really, of betting on the future and using as much information as we can to think about what that future may look like. So there is no, if this then that. If there was, we wouldn't be here. So yes, sometimes it's you want to make sure you never lose and you always win, and it just doesn't happen. I mean, all you can do is fine-tune your strategy over time, get a feel for the market, know when to move your deltas down to 10 versus up to 30, in whatever it is that you're doing. I do get questions like that. How do you set this? How do you do that? It's like, well, you just experience, and experience is sort of tacit. It's difficult to codify because it's what I know inside me and how I feel and how I see things, which to me seem obvious, but is very difficult for me to describe it, or impossible without separating. I shouldn't say without separating, but I don't know that you can separate the knowledge from the experience that I have and write it down somewhere. Let's see, market pricing in 6 cuts 2024, which has pushed it to all-time high. Yep, outside of an unexpectedly severe recession or exogenous shock, it's difficult to see a scenario where the Fed outdoves the market and cuts 200 or 300. I agree, especially considering sustained fiscal support via growing deficit spending in election year. Seems like market has confidently priced in a soft landing. What exactly would be the fuel for SPY to push into all-time high territory at this point? I don't see the catalyst. Well, you can think of 2 catalysts, a behavioral and a fundamental one, right? So fundamental is earnings start coming out better. Predictive AI really starts to pay off. Companies are realizing significant cost savings and increasing their earnings that way. Inflation falls really fast, faster than we thought, and the Fed does move to cut rates because with the drop in inflation, real rates start increasing. So they actually do cut rates 6 times or 7 times this year. Because we are facing deflation. So that could be a catalyst. So I'd say it's either something that, without the economy falling apart, cutting rates, that would have to be inflation. Inflation dropping really fast, or earnings accelerating because of both either real growth, combination of real growth and efficiency on the balance sheet. Random question: if you pay 20% cash tax and a 100 cash expense that is not CapEx but is classified as an investing activity, how can you call it an expense but classify it as an investing activity? For it to be an investing activity, it would have to be capitalized, which means it has to show up on the balance sheet, not the income statement. So you simply can't have that. I can't imagine a scenario where you expense $100 but still call it an investment. You've expensed it. How can it show up in investing activity? Okay, your scenario can't happen unless you can give me an example of how a $100 cash expense, and I get that 100 is just an example, but how a cash expense, something you've expensed, ends up on the balance sheet when it's on the income statement. For it to be an investing activity, it's got to show up in long-lived assets somewhere. So the setup is flawed. I don't think we need to read the rest, because the rest is probably based on this setup, and the setup can't happen. So maybe that's the answer to your question. 2014 agency has had negative growth rate in their monthly dividend. Yeah, because there was no yield. I mean, there was no yield at all. Now, where were yields? I mean, they were non-existent. So think about having a portfolio of bonds, and remember now, when you're getting, they're holding these MBS, right? And MBS is paying principal plus interest plus a prepayment, and rates are coming down. So the prepayments would be increasing, and that means they have to buy new MBS at lower and lower and lower and lower yields, right? So you can think about the whole portfolio having, and I'm just going to make this up, let's say, because they hedge out, let's say they take the spread and lever it up, and the spread was 200, they lever it up, let's say 7 times, they're getting 1,400 basis points of spread. And the spreads just keep dropping. I mean, what were mortgages at one point? 3%, right? The 10-year was 1.5%. So your spread just keeps dropping and dropping. Whenever they're getting these prepayments, they have to reinvest at lower and lower and lower rates. So you're not getting this. The only way that you can maintain your dividend is to take, as you're getting lower and lower rates, go from 11 times leverage to 12 to 13 to 14. Well, at some point, if the market turns on you, that'll just wipe you out. So there was no yield at all. Well, what have they been doing the last couple of years? Well, they have been buying at higher and higher and higher yields. Prepayments have slowed down when they'd probably like the prepayments to be faster, but all principal and interest were being reinvested at higher and higher and higher yields. So over the next while, that should drag their price up until rates start dropping and you get to 6-7 years out. Then you'll start to see it again where, hang on, their dividend is going down and down and down because, yeah, they're reinvesting at lower and lower and lower rates. Trying to value a stock using a DDM, but I'm not sure what growth rate to apply to the dividend. That's going to be a function of the yield they're getting, which you have to pay attention to. They'll tell you what their all-in yield is and their leverage. And you'll have to have some idea of where yields are going and where their leverage is going. That's a tough one to do. That's a tough one to forecast because it really just is a function of where spreads are going and what they're going to do with their leverage and where rates are going. You're really trying to forecast all that as opposed to management strategy, right? Any suggestions on determining what growth rate to use for the dividend? No, none at all. None at all. I've been practicing selling calls, puts for income this year, relatively low deltas. I'm in Canada, trading options on the TSX and American exchanges. And so you're trading options on the Montreal exchange, but when you say the TSX, stocks on the TSX. Could you please go through early assignment and re-explain the difference between American and European? Well, European is last day exercise only. Whereas American is anytime exercise. Now, they're anytime trading. You can trade European options all day long. You're not locked in. It's last day exercise only. I'm puzzled as how come my counterparts never exercised their option early, even at times they were in the money. Because even if you're in the money, there's still a time value component. It's always worth closing your option in the market than exercising it. The only time it's worth exercising it is if the time value component is so very low and there's an upcoming dividend and the value of the dividend exceeds the value of the time value. Then it's worth calling away from you. But beyond that, it's almost never worth exercising when you can sell in the market and get the intrinsic value and the time value as opposed to just intrinsic value. Some of the ideas, India, Mexico have seen huge runs in the last couple of months, almost reaching all-time high. What's your strategy to jump in on these trains if you miss the initial move? Well, there's a great place for allocation factories. Find some ETFs that track them and start with, maybe 20 or 25 delta puts. And on a good liquid ETF, you should be able to sell them every 2 weeks. So every Friday, sell a 2-week 25 delta put. Next Friday, sell a 2-week 25 delta put. Next Friday, sell a 20, and you'll dollar cost average no matter where it happens to be because you're always selling a 25 delta put. And if you want to build an allocation, 500 shares of something, you do it till you build your allocation. Now, you may take you 3 months to get your allocation because as you're selling 25 delta puts, it may not be put to you. But if you think that there is going to be some correction, well, that's a great way to get it done and get paid while you're waiting. Wait for retracement to start selling puts. I wouldn't wait for a retracement. I'd just start selling the 25 delta puts. Because once you have them, you can start selling the 25 delta calls, right? I'm asking because there are some narratives I am bullish on, but prices have moved to historically rich valuations. That's what narratives will do. Well, they could certainly continue pushing higher. Well, ask yourself this. Is investment going to stop going into India? Keep in mind, you got two things working for you. You got the market itself and the currency. Right? So is the theme dead? No, not by a long shot. That theme is not dead. I think we're at the beginning of a multi-year theme on this one, and that theme is not dead. So if the theme is flimsy, if the theme is dead, the theme is dying, then you'd say, I think the theme is played out, right? And then you'd wanna back off on that. From India here, but INR gaining strength. Historically, INR has almost always lost against US. Has been very rare that it has gained strength. Most PMs in India, when investing in US, prefer unhedged. And almost everyone just expects INR to go down in value every year. I think it may be because India has to import lots of oil and thus need US. Well, they've been buying a lot from Russia at lower than market prices, haven't they? Although direct rupee trade deals with Russia, there you are. You got Russia right. You're way ahead of me. And Middle East countries helping now. Really, well, I don't know. INR was the third best currency in 2023. I felt we lost a lot against US dollar. Guess other currencies just lost more. Okay, I see chart now, and it was over the last 2 years. Somehow it is really difficult for me to think INR will be gaining strength in the long term, as has always seen in losing big. Listen, in 2005, 2006, 2007, we had lived, the last time the Canadian dollar was stronger than the US dollar was 1972. And the US dollar was always worth more than the Canadian. You always had to pay $1 something for $1 US dollar. Always above par, always. Then along came the squeeze in oil prices and the oil sands, Alberta, and the massive investment that went into the oil sands, and the Canadian dollar got to, I think, 90 cents. In other words, it took $1 US dollar to buy 90 cents Canadian. We were trading below par. We had always just expected that we were never, that this is just the way it was since 1972. You're talking 32, 33 years later, we finally revisited where the dollar was, the Canadian versus the US was in 1972. So you get used to such a long period of time that it just becomes the thing. It's just, well, this is what it is. It really just doesn't do anything else. This is where it belongs. That a lot of currency traders lost significantly on the Canadian when the Canadian started going 92 cents, 93 cents, 94, heading up towards par, shorting it just to watch it go to $1.10. Right, I'm talking on the Canadian side now, not the U.S. On the U.S. side, that means down like 89, 90 cents. But on the Canadian side, it just kept going up and up and up. Well, that was unheard of. Trading above par, that's unheard of. So you may just be conditioned with a long period of history where that was the case, and now it's changed. Or it potentially is changed, and you sort of have to change with it. But that was the deal with the Canadian, as it stayed above par for a number of years. Let's see. It's difficult to think gaining strength long term. I've always seen it losing big. I know it is a behavioral bias and not logical reason. Massive FDI would support the logic of INR strengthening. Let's see what happens. Let's see what happens. That's the right attitude. How likely do you think it is that inflation might spike up and resurface? Well, inflation, let's define inflation so that we understand this. And it has a key word here, right? It is a general price increase. General. So take all the sectors of the economy, all right, 11 sectors of the economy. And what we're seeing on these 11 sectors is a price increase across the economy, a general increase. You can have housing, let's say, go up, energy go up, and all other prices stay the same or even come down a bit, or the inflation, being less and less, so you have disinflation. That would not be considered general inflation. You can have sector inflation without it affecting any of the other sectors. And that, the Fed would look at that and say, well, it seems to be, localized to this sector. As long as it doesn't bleed over into other sectors, then it's not really inflation. It's like localized or sector specific, but it's not general inflation. I think it would be tough to get general inflation unless you get an oil shock. You get something going on in the Middle East now, right, where a significant amount of oil comes off the market. A big spike in oil to the 120s, 130s, where everyone thinks it's going to be there for a while, would cause significant dislocations. That would have the potential to hurt more faster than it would lead to inflation if you had something like that happen. If you had some trouble and some oil off the market and oil got to 105, 110, yeah, given a couple of quarters of that, you could see it bleed into general inflation. But you'd see that coming off, coming from some distance, I think. Is there a way to adjust your portfolio theta according to your market outlook? Do you sometimes go theta negative as well? In other words, do I buy? Yeah, sometimes. But I just haven't found a reason to in the last couple of years. I just really haven't found a reason to. Won't a strengthening rupee be detrimental to your gains? No, let's say that I take 10 US dollars. I don't know what the rupee is, but let's say it's 30. Okay, I take 10 US dollars, that'd give me 300 rupees. I buy a stock and it goes up to 600 rupees and the exchange rate goes down to 20. So 60 divided by 20, not 60 divided by 30. Or sorry, 600 divided by 20, not 600 divided by 30. So if the exchange stayed at 30 and didn't get any stronger, then when I exchange it from 300 to 600, divide that by 30, you're getting $20. Well, if you divide by 20, you're now getting 30. You got you went from $10 to $20 on the price of the stock, and you went from 20 to 30 on the appreciation of the rupee in the small little example that I gave. So if you are investing in rupee denominated assets and the rupee strengthens, that means when you take your rupees and you buy your currency back, you're buying much more currency than you normally would, right? Okay, what your thoughts were on exactly how supply-driven inflation is, and if there is still room for supply chains to improve. There's always room for supply chains to improve because companies are always looking to shift, something from this market to that market. So supply channels are static for periods of time, but over cycles they're always dynamic. They're always changing. So yeah, there's always room for improvement. Are supply chains enough to blame that we could avoid a recession altogether? I don't know. Well, here's the thing. We're not going to avoid a recession. It's going to happen. Don't know when. But it's going to happen. They always do. I just don't know when. So, yeah. I think that's all I got on that one. When you say go long Indian or Mexican equities, do you mean purchasing Indian equities in ADR? No, because that would be in your own local currency. I mean buying an ETF that tracks the market. And the ETF might be in your own currency, but it holds foreign currency assets. You mentioned that you'd rather get beta from India and Mexico than the US this year. Are you very sure about being long duration? I am. I'm struggling to understand how the US equity markets won't go up as rates come down. Wouldn't SPY trading sideways down as rates get cut be as strange as the market reaching all-time high if the Fed raised rates? Well, it comes down to how much is already priced in. Like I said, it's very odd that we're at all-time highs given what we've been doing. Is the market pricing in the eventual rate cuts and saying this is where we would be? Let's look past the 5.5%. Let's start looking at the market in terms of 3%. Let's look past all of this, and here's the price. Are we looking past all of it? I don't know. Being that we seem to be divorced from fundamentals, I don't know. Or maybe we're not divorced from fundamentals. I'm just not bullish enough on the fundamentals. That could be that. 20.36 definitely high, but not too overvalued. No, it's not too overvalued, but you are concluding it is quite high. So you're saying, well, the market's not too overvalued. I'll buy it at not too overvalued and sell it at really overvalued. Given what I think growth is going to be on a real basis, I think 20.36 is 2.5 times too high. The premium in selling puts, calls on mortgage REITs like agency ABR would include the 10% dividend. It includes the present value of the continuously compounded dividend. Correct. The present value of the continuously compounded dividend. So if you look in the Black-Scholes-Merton formula on the numerator, you have the price over the strike price minus R. Minus R plus, minus R minus Q. I think I'm trying to do it from memory here. And that is and these are all continuously compounded, because this is how you get this into a continuously compounded form. You take the natural log of this, right? And this is continuously compounded, and that would be continuously compounded, so that the combination, the call would be lower and the put would be higher in value, such that the combination of the two, creating a synthetic, would have within it the present value of the continuously compounded dividend. Of course, adjusted for the fact that you are at a high rate of interest. So if you say, but the premium, the credit I'm getting, the credit I'm getting is not the value of the dividend. I've calculated this. Well, yeah, it is less the carry. You have a high interest rate, so you have negative carry offsetting that dividend. But it's in there. Yep, it is in there. With housing prices at all-time highs, affordability at historic lows, what would it take to see declines in housing price index in 2024? Is the lack of supply too much to overcome? What would it take? For housing prices to come down? Beats the hell out of me. I don't really see that happening, given the supply and demand dynamics we have and the level of household formation each year. I just don't see it happening at this point, unless there comes some innovation in home building where we can build multifamily units in 4 days. Massive multifamily units in 4 days at a cost of $320 rent for a 2-bedroom. Unless there is some massive innovation that comes along where you can erect housing really, really fast, really, really cheap. Now, whose backyard are you going to put it in? Not mine, right? Anything that can be built that fast, that cheap, will have a certain type of clientele, and I don't want them in my neighborhood. Do you want them in yours? Right? I mean, that's why I paid, that's why you pay millions of dollars to live in a certain areas, because you want other people who can also afford $1 million to live in those areas, and you're not interested in affordable housing, except when you're on social media telling other people they should be interested in affordable housing. Are you starting to get what a modern day liberal is? It's performative. All you have to do is perform liberalism, and you're a liberal. You don't actually have to be one. You just have to perform one. Could you please remind me what OAS are? That is a credit spread adjusted for an option. Option-adjusted spreads. What kind of information it gives us? It tells us how much more you're getting paid above the risk-free rate to take on default risk. That's all it is. How exactly would you gain exposure towards India and Mexico? ETFs. EWW is iShares. It's BlackRock's ETF for Mexico. I haven't looked into one for India. What's your take on investing in Canadian real estate, either directly or REITs? versus the backdrop that the government might one day go after capital. It would be difficult to go after this type of capital because just the sheer number of people who are homeowners and they are a huge voting bloc. If you're going to go after capital, you want to make sure that the people you're going after are too small to affect an election, which is why successful people are a great target, especially if you're going after the 1%, the famous 1%. Let's go after them. Why? Because they can't change, their vote just can't change an election. And what you're doing is creating an enemy everyone can sort of get on board with. Yeah, it's their fault. It's their fault. Those people who built businesses and created employment and sacrificed, it's their fault. How dare they give me a job? How dare they? Right? I'm in Costa Rica now, so I shouldn't say I should say ay caramba. Is it ay caramba or I don't know. There we go. In my understanding, before the pandemic, global liquidity didn't reach the consumer. Yeah, that's not true. On the fiscal side, it did. Governments sent people checks. Canada was big on that. They were just sending out checks to anybody and everybody, and then after the fact, they said, "Oops, I think we got scammed." Still trying to collect all that money. Banks were the loser of 2008 financial crisis, and credit formation was anemic. The bulk of the liquidity were contained in financial markets, bidding up bond price stock markets. At the same time, we had low price of oil thanks to fracking industries. You point that last decade we had QE and near zero interest rates without inflation. It should not be different now if we have an expansion. Inflation depends on the relation between money with goods and service. Technology improves the supply of goods and service, but liquidity grows much faster than supply. Inflation should be expected. Asset inflation doesn't mean you're going to get goods and price inflation. That money, that liquidity has to find its way into consumers' hands and then find its way into the mall. If all of that money heads into the market and finds its way into financial assets, it never hits the mall. We don't go running to the mall with our money. That's why we have money. I don't know how much of an equation you need to write to figure that one out, right? So you get asset inflation, yes. So bond prices go up, equity prices go up, money gets squeezed out of markets into alternative investments, property values go up, all sorts of things go up, and the investor class always wins when there's liquidity. And it's not as if we're doing anything wrong, it's the policy that is misguided. Right? Because none of that money, well, I shouldn't say none of it, but a small amount of it actually finds its way into the consumer's hands through increased credit. But look at what you're doing. You're giving them credit, like giving an alcoholic a bottle of wine, saying it's party time, right? All credit is going to do at some point is create a problem. So we're looking for the source of the real problems. It's misguided policy by people who think they know what's going on, people who think in their mind that they have the ability to engineer what they probably don't even understand. As we can tell by the summary of economic projections, those 18 people in the room who are really smart central bankers have been terrible at forecasting, absolutely terrible, and they're attempting to engineer the very thing they don't seem to understand. Think about that for a second. So my success is not me being greedy. It is stupid policy that just simply throws money my way. It's like, well, what do you want me to do? Right? Not pick it up if I see a $10 bill on the street, just walk past it and say, nope, trying to be a good citizen. I don't think so. Wondering, what do you recommend to invest in for creating exposure to copper? COPX. You can buy COPX, COPX. It's a US dollar ETF, but in your RRSP, you can buy US dollar assets. With your outlook on SPX and the price of vol, and the prices of vol, is worth considering a straddle, strangle? If so, what tenor would you choose? Well, I said my outlook on S&P was flip a coin. I could go either way. I wouldn't, so because I have no real opinion, I would follow no real strategy. I would do nothing. So I couldn't say that I would do any of those things because I have no opinion. Opinion on taking level 2 this year. You describe, well, I'm going to make this really quick. I did read this one. You describe a very large obligation that you have in your life. I don't think you have time. I don't think you have room. I don't know. So, I mean, look what you got going on. First child due February 12th. Taking a 6-month leave. You also have 3 dogs. You have a $2 million new business target, £2 million business target. You got to come up with, I don't know where the business is coming from. Relationship management. Firm will only pay for, will not pay for level 2 if there's no business reason. I don't want to do it anyways, I want to do it as it's challenging. Personality, use work optionality. Not as strong as you think. Too much to take on in your opinion. I'd say get a baby behind you first. You need 3 years of work experience, and I don't think that the job you're doing would qualify as work experience if it's relationship management. It's got to be either asset management or analysis. So you can't get the 3 letters until you have those 3 years work experience, and you don't have them, at least from what I'm reading. So I would just say, spend the time with your kid. That's the more important thing in life. Figure out where you're going to get your $2 million of new business from. Focus on that. My suggestion, you don't need this in your life right now. And life is long. Come back in a couple of years and revisit it, but you don't need this in your life right now. Let's see. I know most of your 2024 ideas are long-term. Which of these do you think are more short-term, 3 to 6 months? Duration. I think duration is going to hold up very well. I think duration wins. Duration. Let's see. Let me know your thoughts on the following points for higher inflation, rising budget deficits due to populist politicians, increased treasury supply. Okay. I don't know why that's inflationary, but okay. Aging demographics, higher sticker spending as retirees cannot get fired and join unemployment in a recessionary scenario. Plus COLA allows for spending increase with inflation. Yeah, but they're past their peak spending years. They don't buy new furniture. They rarely buy new cars. Usually their cars are now 15-year cars because they don't really drive that much. They don't really buy a lot of new clothes. They are a certain size, and that's the size they're going to be, and many retirees are lost in some decade somewhere. So they don't really buy a lot of clothes. They're not buying new music. They're not buying, new flat screen TVs and new electronics and new iPhones, and they just don't spend a lot of money on that kind of stuff. They go on vacation, but most retirees in retirement spend a lot less than what they say they're going to spend. They mostly, movies, dinners, concerts. They start, and this is not everyone, right? That may be 15 or 20% of retirees that actually can have the wealth to do what they want. Most are just happy to get by each month on their pension. So they're past their peak spending years. The peak spending years are right around age 45. After that, spending drops. There's no kids in the house. They have no, there's no tuition to pay. They're not raising any children. It's pretty much done. So they're not big spenders per se. Where they do contribute to inflation is by leaving the workforce, because they make the workforce smaller. So who cares about aging demographics? Capacity utilization is at 80%. Public spending is crowding out more productive private investments. Says who? Look at the issuance of high yield and investment grade bonds this year was higher than the year before. Companies have no problem raising debt, and capacity utilization being at 80%. What capacity is that? It's is it? If we're thinking about existing capacity, and you can get productivity improvements, who cares if it's at 80%? Technology is a killer. Like I've been doing the communications video, and here I'm looking, and I'm looking at the telecom sector, and just the move from 4G LTE to 5G, and what 5G opens up, especially in private networks, the possibility of what it opens up, that there are applications, industrial applications that require super low latency and very high reliability that 5G can deliver. That once you put those networks in place, the amount of automation that can rush into those facilities is enormous. You know, everyone keeps talking about the AI revolution, 5G is really just starting to roll out. You know, it's every generation's about a 10-year generation. So you can start looking at 2030 for 6G. But the capacity that this has is significantly higher, and the bandwidth it has is significantly higher. And if they could get the higher bandwidths working, the millimeter wave bandwidths working, the gains are, you know, on an order of 100 times, not just 2.3 times faster. You talk about 100 times, a gain of 100. Think about what that can do for automation, for vehicles talking to other vehicles. And I'm a firm believer that true automation, true self-driving cars will not happen till you have smart cities and smart assets out there, where vehicles can talk to other vehicles, can talk to the road, can talk to the lamppost, and everybody's walking around with a device on passenger mode. So that every device is doing all of the communicating. You need 5G for that. And the rollout, when you look at what T-Mobile is doing, what Verizon is doing, AT&T is doing in terms of how quickly they're rolling out 5G. In the mid-band spectrum right now, certainly not in the millimeter wave spectrum, but they are bringing that to that mid-band spectrum and really increasing the amount of bandwidth and the capacity that they have. Just that little thing alone globally is huge, right? Just the sheer amount of productivity gains you can get from that, and the cost savings that you can get from that, and the amount of labor that you can reduce in certain factories in certain areas because of that. It is massively deflationary. So, you know, capacity utilization, so what? You may get to a point where, you know, you don't really need to build new facilities to get significant output increases. And that, I'm just pointing to one thing. Now, that's not layering on all of the generative and predictive AI. And for that, especially for the generative AI, if you're going to walk around with a device that can generate, you can't do it here. That network's simply not going to do it, not with the sheer amount of data that you need. It's not going to get it done. You need these networks. So it's, you know, this is unfolding, and I think, you know, sort of, we hear about it, but just not enough. I think the hype isn't big enough on that. So technology is deflationary, period. So no, I disagree with Merrill Lynch. Adding your own points on how lower rates will reignite inflation. I don't have my own points. The only argument so far I hear is Kathy Wood's argument that technology will overcome all of this with spectacular productivity boom. Well, I guess she's been listening to my videos. What in particular made you change positions to tech deflationary? Well, I think I've always I've always had the opinion that technology is deflationary. I don't know. I'd have to hear the opinions I had. I mean, you forget, you know, from time to time what you said a year ago. I'd have to, you know, if you can give me a link to what I said a year ago and the reasons I gave. But I remember doing one video where I listed, you know, the thinking was, well, the U.S. economy is going to grow really slow for the next 5 or 6 years, and I put a video out saying no, it's not. the sheer amount of capital, the entrepreneurial spirit, the pace of technology, it is the locus of innovation globally. If you look at which countries have the most amount of patents being filed, it's still the U.S. by far, still the highest amount of capital, the highest amount of entrepreneurship and innovation. That having low growth doesn't seem likely. Yeah, I guess I'll just leave it there. Any considerations for targeted small cap plays for 2024? Not really. No, not really. Can you talk a bit about SOMA, what it is and why it's important to markets? SOMA is, remember QE, central banks were buying bonds? Well, that went into something called the SOMA, the system of open market account, or systematic open market accounts, or something like that. And that is all the result of QE. So QT is reducing that particular allocation. Why it's important to markets? Because it reduces liquidity. It does take liquidity out of markets. It's like draining a swimming pool, right? I was shocked. My last question, which I repeatedly 3 times was skipped over for the very reason, and I did follow the Q&A each week, could not find it. It was repeatedly 3 times was skipped over for the very reason. Well, I'm not sure what very reason it is. Not entirely sure what happened, but I usually log off my account after leaving the comment. Let's try another one. Initiated a yen-US carry trade in IBKR with hedging by selling high delta put options on yen futures. Let me think that one through. Okay. The hedge worked exactly as it should through the big run up in yen. So that your put option should have gained value, is what you're saying. Even if the yen had gone the other way, the losses on the hedge would be neutralized by the gain in the negative. If you're selling, if it went the other way, the loss. Okay, I don't know what you're doing then. The high delta options apply. Okay, I can't see in my head what you're doing, so sorry, man. I'm gonna pass on your question. It doesn't make sense to me. So, a few weeks back, I asked you about a small cap company trading around 80 million market cap, 20 million free cash flow, positive net income, 12 million. Company owns sand mines, sells a special type of sand to E&P companies for oil and natural gas. Purchased a sand mine in Wisconsin for pennies on the dollar that can ship sand to companies in Canada. Canada appears to be invested heavily into LNG. LNG Canada is building massive operational this year. How familiar are you with the future prospects of LNG? Not very. Yeah, not very. Do you think they will become a significant player in the LNG market over the next decade? Well, if you're going to keep Russian gas off the market, Europe's got to get it from somewhere. So if we think about it that way, sure. Sure, why not? Do you believe that the relatively low premium in IV and Oxy puts is worth the risk? The risk of what? Owning a company with great cash flow? Sure. If you mean the risk of it being put to you, if you don't want it put to you, then you really should be selling puts at much lower premium. If volatility isn't there, volatility isn't there. There's nothing you can do about it. That's the unfortunate thing about the market, is sometimes it gives you great opportunities, sometimes you got to really dig for your return. And sitting around waiting for volatility to come back could mean foregoing a lot of smaller gains along the way. Do you also see Japan, the yen, as promising trade since Buffett's investment and the potential ending of YCC? Well, YCC will push the yen up, and as it pushes the yen up, it'll unwind that carry trade, which will push the yen up. So it has more tailwind than you think. So yeah, I think it's a tough one to play though, right? Because Japan's debt is huge. I mean, it is massive. What makes it manageable was yield curve control, was keeping rates so very, very low. If you start raising those rates, you strengthen the yen, which kills the carry trade, which may kill a whole bunch of the treasuries that the Bank of Japan is holding, a trillion in treasuries that it's holding, raise the cost of debt for Japan, and make their exports less and less attractive because the yen is increasing, while making oil imports more and more attractive. So that's a tough one to play. I wouldn't want that job. Copper ETF available, COPX for a copper ETF. Copper ETF, COPX, can be bought from France. Many restrictions to buy US stock or foreign ETFs. Then that is a job for Google. I heard a friend on YouTube say you have a protege. Could you please share the methods you are using to train her? Well, that's not in place anymore because I left the country, and I do not like working at a distance. Either somebody is beside me or that's it. I do not. You need the give and take. You need the back and forth. You need to be co-located. You need to be in a constant conversation because there are learning opportunities all the time. And you can't schedule them on a Zoom meeting twice a week. I really do think that companies that are using remote work for just regular, everyday operational things, HR works here and accounting works there and IT works here and everybody works at home, I think they're doing themselves a disservice. I think they probably move at glacial speeds. I think they move really slow, and I think that any other company, like there are some people you can have, high performers or critical people that you can have saying, listen, we don't have very many of these type of people. And so this one can, if this one only wants to work from home, then maybe we have to make an exception. But when you're average everyday staff, and let's face it, in every organization, if you have an organization of 100, you don't have 100 stars. Okay, you don't have 100 stars. You got 80 average people and 20 stars. That's just the way it works. It's just the way it works. You can't have your average people working from home. It doesn't work. It just doesn't work. I don't care what you say. Oh, but I work from home and I'm very productive and blah. Of course you're going to say that. You work from home. What a great job. You work from home 5-6 hours a day and you're going to tell me you work more. I know you're going to tell me you work more, but you don't. Come on. You don't. So it's just, that's the big problem. It's, the remote work is not a thing. And this person is not leaving Canada. So that's it. Really great idea, which begs the question, why would you give them away for free? Never occurred to me to charge for them, I guess. Why would anybody pay me for those? I don't know, maybe I just undervalue what I do, but it just seems to me that it's, I don't know, I just can't see myself putting a price on doing that. I have an applied course that I do sell. That's where the revenue comes from. Because, well, you got to generate revenue from something, right? But this is more of a, I don't know, hobby. I think it's fun. I think this is fun. So let's see. Did you consider moving to the U.S.? I did. What would be the pros and cons in your opinion? Pros of the U.S. is it's a culture you're familiar with, right? Most Canadians are very Americanized anyways. It's a culture you're familiar with. The cons, and I'm sorry, my U.S. friends, the cons, the guns, my God, the guns. Just the sheer amount of guns. Just today, another school shooting. Just the guns. The guns was just a big thing. It's like, you don't even, here in Costa Rica, there are guns. But you got to get in a bad person's way for a gun to get in your face. But in the US, it's very logical. Like, you know, certain things you avoid, bad neighborhoods and schools, because there's always shootings, right? I mean, it's just the guns. It's the guns. That was the big thing, was just, you know, every day, every second day, there's a mass shooting somewhere. And a mass shooting is, I think it's like 3 or more. Not deaths, but 3 people getting shot or more. I think there's been, like, last year, what was it, 600 and something mass shootings, 700 mass shootings of 3 or more. That's 2 to 3 that's like 2 to 3 a day. You know, and you don't even have to be doing anything wrong. You could just be walking through a mall and someone decides, no, I'm having a bad day and I'm taking some people out. Like, it just, I know that I'm going to have some Americans stepping up to say, well, you know, what solves that problem is more people having more guns so that we can shoot these people. I'm sorry, my American friends, but it's the guns. It's that was on the list of negatives, is just the guns. Now you may say, oh, you're in a more dangerous country. No, I'm not. No, I'm not. If you remove the drug-on-drug crime, which I have nothing to do with, it's not that bad. It's nowhere near what it's like in the U.S. And the gun ratio per person is off the charts in the U.S. There are more guns per capita in the U.S. Than in Colombia, where the drug lords hang out. So, the guns, man. When I lived in Cleveland, I lived in the East End because that's where the university was. I mean, I'm not speaking from just what I hear on TV. I'm speaking from experience. I heard gunshots every night. Every night you hear gunshots. Every night. You don't hear about a lot of those dead kids either. In East Cleveland, it doesn't make the news. You just don't hear about that. And Black Lives Matter is nowhere to be found for those dead kids. So you have to ask yourself: do Black lives really matter to Black Lives Matter? If that doesn't get them going, right? You know. So let's see. Is listening to your comment about how people are inclined to criticize you personally for a decision. I want to share and recommend the audiobook from Great Courses Company, Thinking About Capitalism. He discusses the initial chapters, the views and concepts inherited from civic republicanism in ancient Greece and Rome, where the individual is supposed to put the country above his interests. My personal opinion on the matter is we have politicians pushing and abusing these values for their own ends. Well, I mean, this is what you have with political parties now, right? You have the party before the country. And unfortunately in Canada, we have the kid running the show here. I say the kid because I don't want to give him any respect, because he doesn't really deserve much, you know, parading around with his father's last name. It's his brand before the party brand before the country. So it's you know, there is no country first, I think. About your preference to avoid beta, how about considering equal weight index, assuming the soft landing is actually happening? I mean, if we take out the so-called 7 stocks, the rest of the S&P were in fact down year to date before the recent rally, and the recent rally equal weight outperformed S&P. So if this rally has a leg, it seems the money wants to chase the rest of the mega caps. I don't have an opinion on the market. I just don't have an opinion about Capri. Was on board with you on this idea in general, but I see bearish technical. Okay, I stop right there. Can you comment on the Japan market and yen outlook? Not really. I really only know one market. I mean, you can't possibly know all the markets. There's just too much to know, and if you try to, you won't be any good at any of them. I don't even know the Canadian market. If somebody said, how's the Canadian market doing, I'd say, I have no idea. The TSX, what's it at? I got no idea. None at all. Zero. I know nothing, really almost nothing about the Canadian market. So it's always just been the US market. Do you foresee governments like the Canadian one implementing laws where some savings institutions would be forced to maintain a fixed percentage of bonds? Not really, because we don't have a banking system like there is in the US. We have a very small number of banks. 6 big banks pretty much control everything. And then you have some smaller banks here and there. But the big 6 pretty much own everything. You don't have a lot of the selling of bank loans and selling of mortgages from the balance sheet either. Bank makes a loan, it pretty much holds that loan on its books. So the securitization market in Canada is, you can call it almost non-existent. So when a bank makes a loan, there is no originate and sell model. It's originate and hold. And because they have to hold, they're a lot more careful about what they do. So I don't think so, no. Canadian banks haven't really caused the Bank of Canada the grief that American banks have caused the Fed. So no, I don't see that. Do you foresee a day where Canada sounds unattractive to foreign investors like China? Canada has natural resources, so it'll always be attractive to that extent. Canada is not really a very attractive place for setting up facilities that produce something to send it out. So we don't have an industrial strategy per se in that respect, that a company comes and they set up a facility and they buy the natural resources, transform it there, and then they export a finished product. They usually just export a raw material. And Canada has lots in terms of timber, agriculture, beef, minerals, oil, natural gas. It is, resource rich, but transformation poor. We don't, with all the oil we have, we really don't even have refinery capacity. We sell our oil and we buy our gas from the U.S. So I don't know that it's as attractive. Unless there is some kind of resource boom somewhere, which that's what the oil sands was, and that's pretty much dead now. In your explanation for why socialism fails, you gave a scenario where an authority would cap your own investment choices for the sake of preserving income and wealth equality. They would somehow force you to save a portion of government savings, let's say 50%. Well, that doesn't sound like a question. But I think the forced savings rate in Canada is 5.5% if you're employed. So you have CPP, and then the employer has to match the CPP, and I think it comes to 5.5% of your income, which is forced. You have no choice about that. So there is a level of forced savings already. But if you somebody had asked a question, and I'm going to do a video on this one because not as many watched the Q&A, but somebody had asked a question saying, if you could design a better economic system, what would it be? It wouldn't be anything. It wouldn't be anything different than what we have right now. The problem is not the economic system we have. Capitalism is not the problem. Capitalism is a solution for almost anything you can imagine. Any system you design will have problems. It's not a matter of fixing capitalism, it's a matter of fixing human nature. If you want a better system, fix the humans. Don't fix the system, fix the humans. Find me one system ever in the history of the world that had no corruption, no crime, no inequality, no greed, no murder, no rape. Find me one culture, one economic or political system in the history of the world that had none of that. You won't find it. Why? Because every single one of them had one thing in common: humans, human nature. Right? So it is not capitalism that's broken, really. It is human nature. You want to fix capitalism, fix human nature, and good luck with that. not without a very top-down, very rigid, tight structure can you fix human nature. Is there any Indian or Mexican company anyone would recommend? Okay, that's anyone, not me. How are you getting exposure to India? You'll get with an ETF. Where do you see TLT going in the next few months? I see it maintaining 95 to 100 at a minimum. I don't see it dropping below 95, and it may push above 100. But I think until the Fed actually does cut a rate, I think we're kind of range bound. We should be range bound. Any recommendations for an ETF? EWW. What are the reasons you haven't considered Boardwalk? I just don't like them. I just don't like them. Maybe they are a great company. I just don't like them. Period. I just don't like them. That's it. There's no other reason. I just don't like them. I lived in the Boardwalk building once, and it was, I wouldn't say a bad experience, but it was just, I was unimpressed with management. I was unimpressed with the way they did things. I was unimpressed. It was just, I just always felt that they were trying to, you know, the way that they did the lease turnover, they said if you renew in the next 24 hours, you'd get something. So I renewed in the next 24 hours, but then they extend, for another 1 year lease, which I thought was 1 year, turned out to be 14 months, but they didn't tell you it was 14 months. So after a year, when you give your notice, they say, oh, but you'll owe us 2 more months. You can't break a lease. It's like, I signed for 1 year. No, you didn't. It was 14 months. But 14, who signs a 14-month lease? It was just this little sneaky, greasy way of extracting money from you. This is just, you did this on purpose. You did this on purpose. That's the ugly side of capitalism, is when you got to rip off your customers, and you got to, I just don't like them. I just don't like them. I just don't like them. Maybe they are a good company, but you got to have principles. When you're treated badly in one place, you say, I'll never step foot in here again. Even if they're having a 90% off sale, you got to stick with your principles and say, nope, I said I'd never step foot in here again. Well, I'm never stepping foot in there again. I just don't like them, period. Anyways, that takes us to the end.